The big announcement really coming out of the annual monetary policy is the fact that the repo rate has been cut much more than what the market was expecting. It's been cut by a half percentage point against a broad expectation of a quarter percentage point cut. The bad news, though, is that the RBI has categorically said that no one should expect any further action on the policy front from the Reserve Bank of India, simply because inflationary considerations continue to hold up, and that the RBI's focus will remain on tempering inflation. Now, I'm just going to introduce our guests on the show this morning that we've got Sajid Chinoy, who is India economist of JP Morgan, with us on the show. There's K.R. Bharat, who is the managing director of Advent Advisors. There's Janak Desai, who is wholesale banking head at ING Vaishya Bank, and we also have Srinivasan Varadarajan, who is executive director at Axis Bank. Sajid, I'm going to start with you. Now, what the RBI has said in the policy document that it's just put out is that the stance of the monetary policy is intended to adjust policy rates to levels consistent with the current growth moderation. Now, would you agree that a half percentage point cut by the Reserve Bank of India on the repo rate front, and an indication that you aren't going to get anything more for the foreseeable future, is a cut that is indicative of the growth moderation that we've seen and the need to adjust, or rather to support growth and bring it back?
Yeah, I think it's a bit aggressive. It's a bit surprising given the own parameters that the governor laid out. I suspect what's happened is, as we were discussing earlier in the show, the RBI recognizes that the window of acting is very limited. Come May and June, once the base effects wear off, these inflation numbers head north very quickly. And in that environment, it would have become very difficult to cut rates any further. So what I suspect they've done is they've figured out what the total quantum of rate cuts for the next few quarters should be, or what they expect to be, and front-loaded that today, just given that they have this window. And I think that's really been the strategy behind their move today.
Right. We've also got K.R. Bharat with us. Bharat, focusing on the equity markets, you are a senior voice in the equity markets. Would you say that after today's cut on the repo rate front, one could expect some sort of a re-rating of stocks, financial sector stocks, or would you say, to the extent that the RBI has given a guidance that you aren't going to see anything more in terms of rate cuts, you would tread with a little caution? Also, the fact that you continue to have huge asset quality concerns within the financial sector.
I think what is very, very significant is what the RBI governor actually said. And, if I hadn't told you, for instance, that there'd been a 50 basis point cut and asked you to listen to that speech, and at the end of that speech asked you, so what do you think the RBI did? I can bet you wouldn't have come up with RBI cut interest rates for 50 basis points. So I think you need to, I agree with the view that's been expressed earlier that I think the RBI has front-ended. I think what the RBI has done is told the government, look, we are giving you benefit of doubt. This is what you wanted us to do. This is what we're doing. And now the onus is on you to control the fisc, to manage the subsidy burden, to manage your debt, to manage the current account deficit, and to manage the rupee in such a way that you don't let us down, that you sort of do whatever it takes to control inflation, and most importantly, to manage the fisc and the current account deficit. As far as equity markets are concerned, I think markets will get exuberant. They will sort of react very positively, as indeed they should, to what has happened. But the reality is that this is just a statement of intent from the RBI saying, look, you've been critical of us for so long that we've not sort of cut interest rates. Here you are. You expected a 0 to 25 basis points cut. We're giving you a 50 basis points cut. Now let's see what happens. What I see going forward is that controlling inflation is going to become a big challenge. I think what the RBI governor said about food inflation is something that bears a lot of attention. One should pay a lot of heed to what he said. And I think now the ball is now firmly back in the court of the finance minister in Delhi, saying, look, the RBI has done what it could. Now it's up to you guys. So I think if the equity markets are sensible, they will sort of take this exactly the way it's meant to be taken, which is positively, but saying, look, nothing more coming from the RBI for the rest of the year, and it's now up to the government to manage the fisc, and that is really where the direction for equity markets is going to come going forward, barring, of course, what happens overseas, over which we have little or no control. That's really the lesson that the equity markets need to take away. I think, we should not give in to exuberance. We should be very positive about this development, but say, look, now, let's look at what happens over the next 6 months in terms of what the government of India does in terms of aggressive reform, in terms of managing the fisc, in terms of managing current account deficit and the rupee.
Okay, interesting perspective. Let's also bring on board Mr. C. Jayaram, Joint Managing Director at Kotak Mahindra Bank, who also joins in on the show. Mr. Jayaram, I'm going to ask you for your reaction. Do you think that you'd be happy with the measures undertaken by the RBI, a 0.5% cut and no more for the future? Mr. Jayaram, that question was for you. What do you make of the measures doled out by the RBI this time around with a cut of a 0.5 basis point? Okay, we're having a bit of a problem with that line, but Mr. Desai, just going to ask you to react to the same. Do you think that this measure was a tad aggressive or was on expected lines and we should take it with a pinch of salt?
No, I think, RBI has done a great job. Effectively, they've surprised most market participants, and so, from a sentiment perspective, it's a huge boost. I think it clears the deck for any impact that possible rate movement could have on investment decisions in terms of, growth in the economy. It also clears the deck for any possibility of interest rate move going forward, and so therefore removes the uncertainty. I think what the RBI has really done is put a ball back in the government's court to make sure that they take control of the fiscal deficit, and the governor actually touched upon it as one of the risks to growth and inflation. The food inflation clearly is a matter of concern, and which will require some amount of measures on the supply side, which is constraining food inflation. So clearly, I think it's a step in the right direction. From a short-term perspective, it's clearly positive for most market participants. Really, and clearly put the agenda on the table in terms of fixing the fiscal deficit and some of the policy steps which need to be taken.
Mr. Jayaram, just wanted to come to you with the same question. We spoke about how the current account deficit, which remains high, very unsustainable by the RBI, as well as the inflationary pressures which continue to persist in the system. Those 2 points seem to be uppermost on the RBI's mind. A, what do you make of this 50 basis points cut in the key interest rates, as well as what are you expecting on these two fronts with the current account deficit as well as inflation?
I think for starters, the 50 basis points decrease is very welcome because clearly the market was expecting only a 25 basis points. And I think it shows a very clear sort of signaling from the RBI that it is sort of prepared to reverse tracks and sort of go down the road of declining interest rates. They've obviously qualified this by saying that they don't believe they have the sort of maneuverability to do very much more in the next few months. But I think what's interesting is that they have clearly talked about the fact that administered prices, particularly fuel prices, are likely to sort of go up. And in fact, he's sort of gone on record to suggest that it should be done. And they would really like to watch what happens to inflation post that. So I think you really have to, going forward now, wait for the budget session to get pretty much close to being over somewhere towards the middle of May before I think there will be increase in administered prices. And I think the RBI would like to wait and watch for the effect that has on inflation before making any further moves.
And Mr. Jayaram, RBI has projected the FY13 GDP growth at 7.36%. What do you make of that?
I think at 7.3, they're below government estimates of 7.5, 7.6. RBI is normally more conservative. And I think while obviously this is an indicative sort of number, I think somewhere in and around the 7% is what most analysts sort of tend to make. And I think at this point of time, while it's been scaled down to 7.3, unless you get some growth impetus back in the next few months, they may well have to scale it down further after a few months.
Srinivasan, if I could bring it to you, the RBI pegging non-food credit growth for the current financial year at 17%. We've had a 0.5% rate cut today. Should we expect that bankers like you will be lowering interest rates? And again, that's one. And two, is 17% a reasonable target for the RBI to have set?
Now, in terms of the non-food credit growth for the coming financial year at 17%, I think that's fairly realistic. I think I would put it in the range of 15 to 16% for next year. We'll have to take a call as we go along in the year whether that is closer to 15% or 17%, but 17% is a good target to work for through the year. As far as cutting rates is concerned, it's a question of cost of funds, and clearly if you look at what RBI has done, clearly lowered the repo rate, but in terms of liquidity, I think they have increased MSF amount. So clearly, rates we need to see in terms of money markets where the cost of funds comes down and the transmission of the rate cut, whether it flows through in terms of deposit rates as well as CD rates. And once we see that, I think we can take a call in terms of what sort of rate cut can be passed on.